Hi viewers, Namaste. We will start F&O playlist from this video, Futures and Options. These are also called as derivatives. This will be my favorite playlist. If you think why, please look at these statistics. This is the market turnover data of NSE. This is taken from FireSwan platform in 25th March EOD report. You can see here the daily average turnover when taken 1 year data into account. In equity segment, on an average, Rs 36,345 crores turnover has been happening. And in F&O segment, on an average, Rs 14,06,000 crores approx has been moving in and out. With this information, you can see how much scope there is in F&O segment. Of course, if we participate in this F&O segment without proper experience and knowledge, the risk will be more than the equity market. So, that's why this playlist, to get full knowledge on futures and options along with strategies. In this particular video, let's throw some light on futures markets. Let us know what exactly futures are, why futures has been introduced, and let us also know which type of participants use futures, and from this we will also know what are the different trading styles in futures markets. So, welcome to the world of Get Trading. To start with, these futures and options are a part of derivatives segment. If you do not know about derivatives, derivatives are contract between two persons, and the value of contract is derived from its underlying asset. This underlying asset can be anything like commodity, currency pair, index, individual share, etc. Anyways, you will yourselves uncover about this derivative as you progress in this video. Small reminder. If you like this video, please don't forget to subscribe to our channel. Please like and share this video to as many people as possible. If you have any doubts or suggestions, please write down to us in comment section. Your each step will motivate us to produce more good stuff. Okay, let's start with a story. There lived two people in a village. One who has so much land and produces rice, and another person who just started his rice export business. Let's give them some names. We will take names of the people who have recently commented on our previous Telugu video. Let us take Mr. Murli and Mr. Jagdish as the names. Mr. Murli is a rice producer and Mr. Jagdish is a rice exporter. Mr. Murli has recently sown the rice crop and is eagerly waiting for the final crop, which will be ready in almost 2 months. On the other hand, Mr. Jagdish has recently received his first order from some country to export rice after 2 months. Now, both these persons have a common worry or a concern, that is, the rate. Mr. Murli is worried about his profits in case of fall in price after 2 months. It may happen, right? And at the same time, Mr. Jagdish is also worried about the rate, but on the opposite side. He is worried that if the rate increases after 2 months, his profits might be reduced. He can purchase the rice now itself, but his storage costs, etc. will be increasing, right? So, both these people can come into an agreement. Mr. Murli will write the agreement that after 2 months, that is, let's say by 30th of June for example, he will deliver 1000 rice bags, each bag having 50 kgs of rice. Let us see some other bullet points. Present day's price per bag is 2500 rupees. Now, Mr. Murli may demand that for delivery on 30th June, he may need 2600 rupees per bag. He may get even more according to the market. Just to remind you, he is worried about that the price may fall due to some reasons. Anyways, as Mr. Jagdish too is worried about the rise in price, he happily accepts the offer as he is exporting at 3000 rupees for suppose. Anyways, this 3000 rupees is immaterial for this topic. Finally, Mr. Murli asks rupees 200 per bag as advance payment or goodwill, whatever it may be. And Mr. Jagdish accepts it too. Now starts the actual subject. This contract deal done by these two parties is called forward contract. Think again. There is no legal entity in between these two persons. If at all these two persons make a contract using some legal entity like exchange, MCX for example, then this is called futures contract. And the market where these futures contracts are traded is called as futures market. So simple. So futures and forward contracts both are same, but as exchange is involved here, this is the safest, right? If not in exchange, on 30th of June, Mr. Murli may say that he already sold the rice to someone else, or Mr. Jagdish may say that his order has been cancelled and so he doesn't need the rice right now. So, to avoid these problems, standards and rules are introduced and followed by exchanges. So, one thing we can say confidently is futures contract is standardized forward contract. Okay, see here. In this contract, it is written in bags, not in cases. In exchange term, this is called as lot size. So, here in this example, one lot is equals to 50 cases. This 1000 bags or lots which they have agreed to trade is called as quantity. So, quantity traded is 1000 lots. Okay, the present day price is 2500 rupees, right? In exchanges, this is called as spot price. Next, the date, that is 30th June. This date is called as expiry date. Now, they have agreed for a price of 2600 rupees on the day of expiry, right? This price is called as futures price. And this advance or goodwill taken by Mr. Murali is called as margin. In actual exchanges, this margin concept is somewhat different. Exchange collects margin from both buyer and seller. So far, so good, right? Let us introduce one more person. Our one more subscriber, Mr. Ishwar. Mr. Ishwar has somehow got a leaked information that some exporter has got a good order and so he is even ready to take rice at 3000 rupees per bag in future. So, Mr. Ishwar will now go to Mr. Jagdish and asks him to sell off the agreement made with Mr. Murli. Mr. Ishwar says that he is ready to spend even more than the agreement. So, he is ready to give extra 100 rupees per bag apart from 200 rupees per bag which is already given as advance. Mr. Jagdish is okay with this offer as he need not wait for 2 months and he can get the profit now itself. So, he takes rupees 300 per bag and handovers this contract to Mr. Ishwar. So, what happened here? Contract is being sold by Mr. Jagdish and being bought by Mr. Ishwar. So, Jagdish is the seller and Mr. Ishwar is the buyer of the contract. Now, what Mr. Ishwar had done is called as speculation. And he is called as speculator in market terms. Those who don't have the security or even requirement of the security will come into market for short-term price fluctuations benefits. Speculators. Actually, we are all speculators too. For example, we buy 2 lots of Reliance futures today and will sell 2 days after when we get our target price. We are nowhere concerned to own or to sell the actual shares of Reliance. We are speculators. If we speculate well, we get profits. If the speculation is wrong, then we end up with losses. Okay, let us see who else participates in these markets. Let us see one more concept. For example, one of our subscriber, Mr. Dorbabu and his friend are fond of cricket betting. Caution, betting is illegal, right? Okay, think that there is a cricket match tomorrow, India playing with Pakistan. These two had participated in a bet with 10,000 each that India wins. As soon as they placed the bet there, news came out that 3 or 4 key players of India will be unavailable for tomorrow's match due to critical illness. Mr. Dorbabu's friend almost fixed his mind that 10,000 rupees had gone and went away from there cursing his bad luck. But Mr. Dorbabu is a clever man. He had some knowledge in stock markets and used a concept of stock market in this situation. He is sure that India loses, but he can't take his bet back. As said, he used a concept of stock markets. He placed the same amount of bet on Pakistan too. Super idea, right? So, whoever wins this match, risk is covered. Amount lost on one team will be neutralized by the gain on another team. He had eliminated the risk. Let us see what is this concept in actual stock market use. Take for example, you own 20,000 shares of Reliance from Rs 500. Now, the price is 1500, say for suppose. Recently, something like coronavirus affected the market. So, you know that market reacts very negatively to it. Now, your portfolio worth for these shares is 3 crore rupees. These like high net worth accounts generally will not sell away their quality shares or quality assets so easily. Even if they decide to sell, transaction charges, etc., and even the effect of capital gains tax will be more. What you can do now is go to the Reliance futures market and short contracts equivalent to 20,000 shares there. Short selling. In Reliance future, one lot is equals to 500 shares. So you need to short 400 lots there at whatever price you have at that moment. Since you think that this disturbance holds for 3 months, you need to short contract in the contracts of after 3 months expiry. For example, if you have taken this decision on February, you need to short my expiry contract, 400 lots. Now, let us see what happens when you do this. One small note before taking you there. In most cases, spot price and futures prices move in a proportionate manner. Like, if spot prices move up 5%, then futures prices may also move up 5% approx. Okay, think that this is not happening. At expiry day, futures prices equal spot prices. Common sense, right? Okay, think that you are not satisfied with this case too. Final thing. At expiry, when you close your futures position, exchanges close the price at spot price. So, considering all these aspects, at expiry time, futures price is equals to spot price. Okay, let us see possibilities at expiry. Either prices close at the same price, higher than or lower than this. Okay, let us do this on Excel. See, for suppose spot price is 1500 and futures prices is also 1500. So 20,000 shares, that is 400 lot, is shorted at 1500 in futures market on May expiry. So let us take these three cases. First, let us suppose price closes at same 1500. No profit, no loss, right? Next, let us suppose price closes at 1000 rupees, which you have expected. Loss at equity market is 500 into 20,000, that is 1 crore rupees. But what happened in futures market? You had shorted at 1500 and now you close your position by buying back at 1000 rupees. So your profit is 500 rupees into 20,000 shares, that is 1 crore rupees. So your expected loss at equities is nullified from the profits in futures market. What does this mean? You have eliminated your risk. You have hedged your position. This is called as hedging, and these people are called as hedgers. Actually, the people we have taken example at the starting of our video are also called as hedgers, as they hedge their positions or requirements. Okay, let us suppose the price reaches 1600. You will be at loss in futures market. But in equity, your portfolio will increase with the increase in share price, the same amount. So, there will not be any much pain to you. Without thinking of reduction in returns, you just thought to eliminate your risk, hedging. Next concept. In theoretical calculations, the actual value of future price should be F is equals to S into e power RT. The basic calculation, where F is the future price, S is the spot price, R is the rate of interest, and T is time in years. There is another complex formula which we can discuss in our next video. Okay, see for example, spot price is 1500 and think that as per this formula, futures price should be like 1540 for example. But if the futures price is 1600 in the near future market, let's suppose which closes in another 30 days, what if you do this in this situation? Buy some shares in spot market at 1500 rupees and short the same number of shares in futures market at 1600 rupees. Let us see what happens when we do this. See from this, whichever price the spot price closes on expiry, that is 1500 or 1200 or 1600, you will get this 100 rupees profit per share for sure. Say this in percentage. This much return in 1 month is more than FD or any conventional returns, right? Of course, these can be impractical numbers, but surely returns will be considerably more than whatever we are thinking. This method is called as arbitraging. Participants who encash these differences are called as arbitragers. Actually, this is called price arbitrage. There is one more method too. Let us see in short. See, for example, if the price of March expiry is 1500 rupees and April expiry is 1600 rupees, you can go long on March expiry and go short in April expiry. So, during the day of March expiry, when you close both positions, there are good chances that you can get the profit near to this difference. This is called calendar arbitrage. As said, we can make separate video on this arbitrage because these carry least amount of risk. This viewers is all about futures market. Let us make some good concepts videos on these futures markets. You can ask whichever topic you want in this comment section. Please subscribe and press the bell icon. Have a happy, safe and profitable trading. Jai Hind.